Covered bonds are debt securities backed by cash flows from mortgages or public sector loans. They are similar in many ways to asset-backed securities created in securitization, but covered bond assets remain on the issuer Euro unregistered trademark's consolidated balance sheet. The covered bonds continue as obligations of the issuer. In essence, the investor has recourse against the issuer and the collateral, sometimes known as dual recourse. However, there exist other variable types where assets come off balance sheet. As of 2012, volume of outstanding covered bonds worldwide was Euro 2,813 billion, while largest markets were Germany, Spain, Denmark and France. Detailed explanation: a covered bond is a corporate bond with one important enhancement, recourse to a pool of assets that secures or covers the bond if the originator becomes insolvent. These assets act as additional credit cover. They do not have any bearing on the contractual cash flow to the investor, as is the case with securitized assets. Before the outbreak of the financial crisis in 2008, this enhancement typically resulted in the bonds being assigned AAA credit ratings. Due to the realization that many of the loans backing these bonds were of a low quality, credit ratings declined sharply. This diminished the demand for all the types of asset-backed or covered bonds, contributing to the global financial crisis. For the investor, one major advantage to a covered bond is that the debt and the underlying asset pool remain on the issuer's financials, and issuers must ensure that the pool consistently backs the covered bond. In the event of default, the investor has recourse to both the pool and the issuer. Because non-performing loans or prematurely paid debt must be replaced in the pool, success of the product for the issuer depends on the institution's ability to evaluate the assets in the pool and to rate and price the bond. History: covered bonds were created in Prussia in 1769 by Frederick the Great and in Denmark in 1795. Danish covered bond lending emerged after the Great Fire of Copenhagen in 1795, when a quarter of the city burned to the ground. After the fire, a great need arose for an organized credit market as a large number of new buildings were needed over a short period of time. Today nearly all real estate is financed with covered bonds in Denmark, and Denmark is the third largest issuer in Europe. In Prussia these Pfandbrief were sold by estates of the country and regulated under public law. They were secured by real estate and subsidiary by the issuing estate. In about 1850, the first mortgage banks were allowed to sell Pfandbrief as a means to refinance mortgage loans. With the Mortgage Banks Law of 1900, the whole German Empire was given a standardized legal foundation for the issuance of Pfandbrief. USA, on July 28, 2008, U.S. Treasury Secretary Henry Paulson announced that, along with 4 large U.S. banks, the Treasury would attempt to kickstart a market for these securities in the USA, primarily to provide an alternative form of mortgage-backed securities. The guidelines issued specifically address covered bonds backed by pools of eligible mortgages. The Federal Reserve also announced that it would potentially consider highly rated covered bonds as acceptable collateral for emergency fund requests. Because the United States has already shown a robust market for other securitized debt products, regulators have been promoting the covered bond market strategy. However, to date there have been very few covered bond offerings in the United States, partly due to concerns regarding treatment of the mortgages and in issuer insolvency as well as uncertainties regarding taxation and other issues. New Zealand, on June 3, 2010, Bank of New Zealand announced that it had launched the first covered bond program in Australasia. Covered bonds issued by Bank of New Zealand will be rated AA by Moody's Investor Service and AAA by Fitch Ratings. No issuers in New Zealand, Australia or surrounding countries have issued covered bonds previously. Australia, on December 12, 2010, the Treasurer of Australia, Wayne Swan, announced that Australia would change its financial regulations to allow covered bonds. The Australian Securitisation Forum has attempted to get APRA to allow ADIs to issue these bonds for several years, without success. More recently the major banks have been lobbying for this, stating that Australian banks would be at a disadvantage to their international counterparts. Legislation authorising issuance of covered bonds by Australian financial institutions won support from the minority Labor government and the opposition in the House of Representatives on 12 October 2011. The bill then passed to the Senate where it was passed the next day, October 13. In November 2011 ANZ Banking Group released Australia's first covered bond issue. See also, Financial Instruments, European Covered Bond Council, Securitization, the cover, references, Lemke, Linz and Picard, Mortgage-Backed Securities, A Section 422. 2013 ECBC European Covered Bond Fact Book, Lemke, Linz and Picard, Mortgage-Backed Securities, A Section 422. http www.thaustralian.com Our Industry Sectors Tory E6FRG 96F1225969660748 http parlinfo.af.gov display W3P Query =it %3A% 22 Legislation %2 Bill Home %2 FR 4669% 22 http www.thaustralian.com or Financial Services Story FN 91 WD6X12261964133380, external links, FDIC Policy Statement on Covered Bonds, ECBC Technical Issues Covered Bond Comparative Framework Database.